Hello, welcome to HYCM's webinar with myself, Giles Coughlin. Welcome to the live market analysis and FX week ahead. I'll just check that everything. Oh, there we go. Let's just make sure we're showing the main screen. There we go. Just waiting for any folks to come in while we're getting started. Just before and while that's happening, just to let people know that as we're looking at different trade setups, different market scenarios, the whole purpose and function of these webinars is not to offer trading advice. So it's not that I'm giving signals, this is where to enter, where to exit. Although we discuss entries, exits, it's all done from the perspective of education. So you can, as it were, look over my shoulder and I'm highlighting where I'm expecting sellers and buyers to enter and the reasons that they're likely to be entering. So the whole idea is about education, so then you can make trading decisions for yourself in the future. Just to make that clear, and particularly if you've just started listening to these webinars, it's important you get that function, and that purpose clearly in your head, so you don't get confused at all. Let me just, there we go, that's better. As I said, we'll be looking ahead, so without further ado, we'll get straight stuck into what's happening. We started this morning and we've got sort of a broadly mixed risk sentiment. Essentially, when I came to my desk this morning, I remember the reason we're looking at equities is we're looking at the equity market to gauge risk sentiment. Equity investors are very sensitive to risks, and when they're feeling concerned, money rotates out of equities and into bonds. So that's why we see equities falling and bond prices rising at times of market uncertainty. So that's why we look at the equity markets as FX traders. So as I came to my desk this morning, we saw that, the Japanese markets are on holiday this morning, so we'll ignore the Nikkei. The Hang Seng and the Shanghai were both down. We had the S&P 200, Australia's 200 index, fractionally up, and we had the India Nifty up 2.89%. Now it's just worth mentioning that India Nifty reading there. The India's Nifty has been boosted by fiscal stimulus from the Indian government. There was a tax cut for corporate taxes, and that has just really lit the Indian Nifty with very large gains, 2.89%. So that's that's why there's the outperformance there of the Indian Nifty. The Hang Seng, the Shanghai Composite, both down on the morning, and the European equities started the day relatively flat, but then they took a big turn with Eurozone PMIs. We'll look at them in more detail, but essentially there was a whole series of very weak flash manufacturing and service PMI data out of France and Germany this morning, and that was reflected in the Eurozone PMI readings as a whole. And the concern is that the manufacturing slowdown in Europe is now spilling over into services. And the reason the market's concerned about that is that the US-China trade conflict is starting to really bite, and that bite is what's concerning the market, why we're seeing some risk-off sentiment. S&P 500 futures are currently just around flat. Dow Jones hasn't opened yet, and I haven't got my Dow Jones futures here, but the Dow Jones futures were down earlier before I was looking at this equity market. So that's where we're at. Risk aversion is quite sensitive, and we're at a real interesting point with risk aversion, because the general picture is that risk aversion has been better. We've been more in a risk on mode with optimism about US and China organizing some kind of trade deal, but it keeps oscillating from risk on to risk off. But the broad consensus is that US and China are going to do something, and the next sort of couple of weeks, particularly over the Chinese public holidays that are going on up to about mid-October. So we're expecting that sort of relative optimism to last, although it's a very sensitive risk sentiment, which is the point I'm trying to make. and you know, these weak Eurozone PMIs are another way the market could respond to the geopolitical risk, and it's concerning the market that the Eurozone is so weak. So that's just a little bit of context that we've got for this morning. I wanted to quickly cover a learning point. We've been looking at we looked at US oil at the start of last week, you see, and this was the opening oil chart on the US oil, sort of 15% increase on the Sunday open, and that was all due to the drone attack which were reported on Saudi Arabia's oil facilities. And what I said at the time was, because of this you know, reduction in potential supply, we want to look potentially for buyers at the 50% Fibonacci level, looking to take profit back at recent highs. And so I just thought we'd follow through to see what happened, because it's helpful to see, you know, what happened, you know, after that sort of you know, scenario is outlined. You know, how did it materialize? I just want to talk us through that as a learning point, really. Well, you can see that the I had my entrance just around here, sort of 58.64, and I was not filled. I was, you know, just out, cut a few points. So that's just the way it goes sometimes. So my fill was missed, and obviously I didn't get onto that move. Now I kept my 50% entry. You know, here you can see that's the 58.64 is the 50% level, right? So price moved down. Some of you guys who are here might have taken it, you know, and I think there was some, I think there was a guy on the webinar last Tuesday who got involved in this move. So I was just missed that entrance. But what I wanted to point out to you was not that, was just simply to point out that when we saw prices drop here, now one of the key things about this price move was all to do with oil supply. So what was driving the prices forward was the concern that, you know, this huge oil production out of Saudi Arabia was going to be offline, so prices would rise. Now, one of the things that we were really laser focused on was the simple point, which was how quickly and how badly was the oil production affected, and how quickly would it get back online. And this candle here was news out of by the Saudi's energy minister, who basically said we're going to get up to normal production very quickly. It was either the end of the week or the end of I think it was the end of the month. So the market had been concerned that maybe, you know, supply will be hit for months, but Saudi's energy minister quickly came on and said no, that's not the case. We're going to get supply up and running in, you know, just a couple of weeks, basically. So that's why we saw oil prices fall, and that's why I did not enter at 50%. You see, once price has gone, this is 2 days afterwards. After about 24 to 48 hours, sentiment changes. But it was this candle here, the news on this candle was that a Saudi energy minister said it's going to be okay in terms of oil supply. So therefore, there was a fundamental shift. Okay, and then the reason I thought it was helpful to look today is we saw two more, you know, flips on production news. So here at the Sunday open, we saw prices spike up, and the reason they spiked up was on the news that Aramco said that, you know, repairs were going to take much longer than thought. So it's back to this, you know, limited supply news. So price rose. And then price broke down through these lows on the news that actually, no, it's fine, supply is going to be fine, there's not going to be an issue. So what's driving US oil? We knew at the time the thing that would be driving the sentiment shift would be the scale that the repairs could be recovered. And we can see, you know, okay, you've got the initial attack, you've got the pullback, return to the recent highs. The drop on the supply level is going to be absolutely fine. The pickup on supply levels is an issue, and the drop on supply levels are going to be fine. So you can see that it's the sentiment shift for US oil at the moment is how quickly oil production will or will not be. So there's just, a quick learning point for those of you who've been following these webinars for a while. You'll see that those moves were, very predictable and weren't a surprise at all. Again, on this move, I tried to enter this move short. I had my entry around here, about 61, just above, and again, my entry was missed. That's just the way it goes when you're really seeking a value of places to enter. Okay, intermarket correlation. This is just a quick cheat sheet for you, helpful for you to know how risk is impacted by these interrelated markets. I'll just give that cheat sheet. We won't go through that now because we spent some time looking at the US oil. Before we get to the week ahead, we'll just look to what the Federal Reserve did last week. Last week, the Federal Reserve lowered their interest rates by 25 basis points. That was expected. The FOMC statement repeated that economic activity is rising, labor market is strong. They said they will act as appropriate. Fed's Bullard voted to lower rates more aggressively. George and Rosengren voted for no cuts at all. Statement pretty similar to the last one, and the market sort of focused on the dot plot, which doesn't show another rate cut this year and just an 8 to 7 preference for a cut next year. So the reaction to the decision was hawkish, and there was mild US dollar strength on the reduced likelihood of future rate cuts and cuts being ruled out this year. The latest dot plot was, illustrating that. I haven't got that here on the chart for us. But the main issue is this: reduced likelihood of future rate cuts. Now, the US dollar strengthened and then it sort of paired back. So I'm sort of neutral on the US dollar. I think the US dollar is waiting for either some catalysts from Fed speakers. This week, we've got a series of dovish Fed speakers. We've got about 2-3 dovish Fed speakers this week. So I could see some of the US dollar strength pairing back even further and some US dollar weakness with the dovish Fed talk that we will likely have. So that's just something to be aware of for the coming week. Now for the week ahead, let's have a look what we've got. So let's just pull up a calendar and then we'll go through the news. Now this was the services PMI data that I highlighted at the start of the webinar. We can see, look, the French flash service manufacturing PMI is down, German manufacturing PMI down. Now this German manufacturing PMI is very, very poor. That is the lowest PMI reading since the heart of the financial crisis in 2009. I'll just see if we can go back here. Look, do you see that manufacturing level PMI reading for Germany is very poor? You've got to go back to the financial crisis to find a lower PMI reading. So that is an alarm bell for the market. And not only is the PMI data poor for the manufacturing, but what we also have the PMI data poor for flash services. So you can see this is the service data here. Now the concern has been what happens when the poor manufacturing data starts overflowing into the service data. That's been and you can see that starting to happen. You can see that the latest service data is weak out of the French flash services PMI. So looking at these PMIs, they're just misses across the board. Manufacturing services, and then the Eurozone. This is the Eurozone was just reflecting what's happening in France and Germany. Don't forget, Germany is the largest Eurozone country. So German data has the most impact on the euro of the individual European nations due to its size. Okay, it's the biggest contributor to the Eurozone GDP, and it's kind of the workhorse of the Eurozone. So that's why it's a very, very important data. Poor reading, and that's why we saw some risk sentiment, negative risk sentiment entering the market. The market's concerned, is this going to be a bad situation? Are we going to see more factory slowdown in global growth? And if we see a risk-off sentiment, well, we're going to see yen and the Swiss franc strengthening, which we did see towards the middle of the European session and just at the end. It hasn't really set in earnest at all, but we're just in that kind of mode. So that's just something to be aware of. Now we've got some Fed speakers. I told you about the Fed speakers that we've got coming up, so they can move the US dollar. Bank of Japan, Governor Kuroda will be speaking. Obviously, the thing with the Bank of Japan is, are they going to be easing, adding to their quantitative easing? Will they go into even further negative interest rates? That's what the market will be looking at. Kuroda for any clues on that. We've got the RBA's Governor Lowe speaking. Again, that's a potential to move the Australian dollar. The Australian dollar, the RBA are now expected to cut rates at their next rate meeting. They've got an 80% chance of a rate cut after some very poor employment data out last week. If you just look at the employment data out last week, we'll just go to it now. So on Thursday, you can see that change in employment, that looks good, doesn't it? But the change in employment, that headline increase was all about the part-time jobs. So whenever you look at it, the Australian dollar employment, you've got to look at the breakdown. Most of those increases were part-time jobs, and the full-time figure fell. Okay, so the full-time reading is the one that has the most impact, obviously, because full-time jobs are good. An increase in part-time jobs are not so good. So the RBA is now expected about 80%. The market's pricing an 80% chance of a rate cut. So obviously, listen to what he's saying will affect the Australian dollar on Tuesday. Again, the Australian dollar is being supported a little bit at the moment with risk on flows, optimism between US and China. So there is some Australian dollar support, but the bigger fundamental picture is a rate cut's being expected. Consumer confidence out of the US. This is an interesting rate. This is the biggest scheduled event of the week. It's the New Zealand dollar official cash rate and rate statement. Now, last month in August, the RBNZ surprised markets by cutting rates by 50 basis points. I took a New Zealand dollar Japanese yen short and a euro New Zealand dollar long immediately on the announcement, and made some quick profit because sellers enter as soon as there's an unexpected rate cut. That's a typical market reaction. If you get an unexpected rate cut, you expect to see sellers enter the market, and that's exactly what happened last month. The question is, will the RBNZ cut rates again this month? And there's a possibility they will. Now, the situation is this. Expectations are that the cash rate will stay the same. The RBNZ is officially on a wait and see mode. What they're waiting to see is if their last rate cut of 50 basis points has done enough to support the economy. That's what they want to see. Now, the RBNZ have surprised markets before, so that means they may surprise markets, and they might cut rates again. Okay, so that's what we need to look for, and the tradable sentiment shifts that traders will be looking for. They'll be looking first of all for a dovish reaction. A dovish reaction would be if they unexpectedly cut interest rates, at which point sellers will immediately enter the market. Okay, so that's something to be looking out for. Interest rate cut, sellers immediately enter the market. If they keep rates the same, but say, we're keeping rates this time, but we expect to cut rates next time and the time before, and we're going to be cutting rates, say, down to 0%. If they said something like that, then you'd see the New Zealand dollar sellers will immediately enter the market. Okay. Now, if that's the dovish scenario, but equally, because the market's kind of thinking, well, there's an outside chance that the RBNZ is going to cut interest rates. If they are the opposite to what's the outside chances, if Governor Orr suddenly turns and says, do you know what, we're pleased with how things are going, we think the 50 basis points rate cut is enough for now. We don't imagine going down to negative interest rates. We think we've done enough to stabilize the economy. We're expecting growth and inflation to get back on track. Now, if that happens, then we'd see buyers would immediately enter the New Zealand dollar, and we'd see New Zealand dollar buyers. Okay, so the scenario where, as it were, traders will do nothing is if they just say, well, we're going to stick to our wait and see mode, and we're just staying as we are. We haven't changed anything from before. We're just still waiting and see, come back again next rate statement. That's when we're going to see the least New Zealand reaction. So that's the, that is the thing to look for. That is the shift that buyers and sellers will be looking for come the event. So make sure you look out for that. I'm just trying to see, which currency pairs will traders be looking to trade now? This is a interesting one, and I'll just go through. If risk is off, to say there's relationships between US and China have soured, and the equity markets are falling, and there's concerns about global growth, etc. Then the Bank of New Zealand is dovish. We'd expect to see New Zealand dollar, Japanese yen sellers. Okay. Say the New Zealand dollar is really, the Bank of New Zealand is really optimistic. Say they think we can see a great situation here for keeping things on hold, and you start getting New Zealand buyers enter, then you would look to pair it against a weak currency. And if risk was on, then you'd find the weak currency would be your yen or your Swiss franc. But obviously, if risk is off, you want to find an alternative risk currency, because you will be having strength in the yen and the Swiss franc. So that's just something to be aware of. Make sure you pair and have a look at risk prior to the rate decision, so if the market comes out one way or the other, which currency pair has the most energy behind it. That's what you want to find. You don't want to be trading two strong currencies or two weak currencies. You want to be getting currencies doing the opposite thing as far as possible. Okay, if there's any questions, just pop them in the question channel for you guys. I think this might be your first time, Hashik and Ignatius. It might be your first time, so if it is, just pop something in the question panel. I'm happy to answer questions as we go along. So feel absolutely free to do that as we make our way through the week. On the Thursday, there's not so much. We've got President Draghi speaking. He's on the way out now, the ECB president, so he's going to be slowly, exiting the European and the ECB rate meetings. And the last real move by Draghi was at the last ECB rate meeting, where he was basically saying monetary stimulus can only go so far. We're looking for fiscal stimulus, so that's government stimulus that supports the Eurozone economy, the kind of thing that we saw out of India, and we saw India's impact on the Nifty. So, any kind of fiscal stimulus that the Euro area does for the Euro is going to be supportive for the economy. So I think the Nifty, what's happened there is kind of a good lesson for the ECB on what fiscal stimulus can do. So that's just one area to be aware of, and that's what Draghi's trying to do. He's trying to say, look, we've done enough as the European Central Bank. Monetary policy can go so far. Now it's kind of over to government to give further support. Cut interest rates are negative. They've virtually announced an unending quantitative easing process. They're tiering bank deposits. They've got TLTRO3 loans are operating. So, you can understand why Draghi is saying, look, there's only so much we can do. And obviously he might choose to underscore that point as he leaves, and maybe try and make life a little bit easier for his successor But in terms of the euro, the more the tradable sentiment shift that traders will be looking for, any indication of fiscal stimulus. So if fiscal stimulus actually looks like it's going to come, then we'd expect euro support. And I expect, on any kind of announcement, I'd expect immediate euro buyers. Bank of England Governor Carney speaking, not expecting that to be any significance, because all the Bank of England Governor Carney is going to say, we can't do anything really until Brexit is organised one way or the other. So Brexit is what's moving the pound. In terms of tradable sentiment for the pound, what we're looking for is it's kind of like, I call it the deal or no deal trading. In other words, if there's a prospect of a deal, pound buyers are entering the market. If the prospect of a no deal becomes, more prominent in the market's mind, we're seeing pound sellers. So the question is it a deal or a no deal? Whichever one is at the front of the market's mind is what's moving the pound. So this morning we saw the pound moving down, and I took a little short on the pound. I'll just show you that. Nothing major, just took like a quick 30 points of the market. So the pound was dropping here, and it dropped this morning on news that Boris Johnson was, not really hopeful about getting a deal done this week, and you see we're just taking out recent lows. So that's why the sentiment on the pound is negative, and at the moment, I'm still expecting sellers on pullbacks. I'm not trading it, but if you put a gun to my head, any return back up to this level, I'll expect sellers at that level to breaking down through those previous levels right now. So that's what's going on there. Yeah. On Friday, some US data. I'm not expecting them to be necessarily market moving at all. So that's it. The main event of the week for me is the RBNZ rate statement on the Wednesday, and obviously there's sentiment shifts of US-China trade information, any geopolitical risk overflowing from the weak Eurozone PMIs today. And anything from the RBA. They're the main sort of highlighted events. Yeah, Hashik, what about gold? Now, gold, let's just have a quick look at gold. Gold is being broadly supported, and this is why. The downside about gold is that it doesn't have a yield. It's not like an equity where you get a dividend. It's not like a currency where you can pair it and get an overnight swap. Gold does not have a yield. It just has its intrinsic value. So that's why it's not that popular as an investment generally. But having said that, interest rates around the world are very low. And with interest rates around the world very low, where do you go to find value? And increasingly, gold offers good value. Okay, so we can see that gold was knocking around this 1500 level. It's kept finding support, and now it's sort of taking off over these recent highs. So I know that a lot of gold ETFs, exchange traded funds, are increasing. There's been a lot of gold buying going on. So as long as we stay in a low interest environment, I'm expecting gold to be bid, and you can just see, look, how gold has been bid in these last sort of weeks since mid-June. Okay, so I'm anticipating gold buyers to enter into the market. Now, I'm not long gold. I'm not intending to go long gold, but that is, you can see the trend is up. So as long as interest rates remain low, and if there's any more concerns, so say we go into a risk off sentiment, say US-China trade war deteriorates again, then we're going to see gold rise. If we get any more bearish news for the US dollar, we're going to see gold rise. So if there's any kind of indication that rate cuts might be coming out of the Fed, we're going to see gold rise. So that's my take on gold, Hashik. Yeah, you're welcome. No worries. Don't forget, we do some training here at HYCM. If you deposit $1,500 into your account, you get a 1-hour coaching session with me. If you get a $3,000 deposit in your account, you get a 1-hour coaching session and 1-hour follow-up review with myself. So $10,000, you get a 2-hour session, 1-hour follow-up review, and 1 week VIP support from me. So that's just an offer that HYCM do. And don't forget, tomorrow we'll be here 1 o'clock to 2 o'clock GMT, and I'll be looking at the online trading workshop, and we'll be looking at some intraday pairs that I'm looking at, and we'll just go through the principle that I use for choosing currency pairs on a day-to-day basis. So if you've never come to it before, don't miss out on it, and come and check it out tomorrow 1 o'clock to 2 o'clock GMT. Thanks for attending the webinar. Thanks for your questions, and I look forward to seeing you tomorrow. Take care now. Goodbye.